Welcome to the Explainer. Today, we're bridging the gap between, those high-level municipal buzzwords and actual boots-on-the-ground business growth. We're going to break down Mississauga's massive Path to Prosperity 2030 strategy. But more importantly, we're looking at how local businesses are actually going to finance the heavy stuff, the forklifts, the trucks, the machinery that's needed to make this grand vision a reality. Let's get right into it.
Okay, let's dive into this. Because, Mississauga really isn't just a suburb. It's literally Ontario's second largest economy. We're talking about a sprawling ecosystem of over 118,500 businesses. But just imagine the sheer friction of trying to prepare a commercial hub of this massive scale for a totally unpredictable future, especially when you're navigating the chaos of a global pandemic and constantly shifting tariffs. I mean, it's a logistical nightmare waiting to happen, right?
And the stakes here, they are absolutely incredibly high. 515,500. That right there is the number of jobs these businesses support right now across the city. That's an increase of over 9% in just a few short years. So, sustainable business expansion isn't just some dry corporate talking point for a municipal report. It is absolutely the lifeblood for hundreds of thousands of livelihoods in this region.
Here's our roadmap to make sense of all this. First, we'll look at the 2030 Prosperity Blueprint. Then, fueling priority growth sectors and the cost of scaling up. After that, we'll dive into financing your business future. And finally, unlocking government-backed capital. So basically, we're zooming all the way out to the macro vision and then zooming right back in to the micro dollars and cents of actually getting capital into your hands.
All right, let's start with Section 1, the 2030 Prosperity Blueprint.
So the economic shocks of the early 2020s basically proved that the city's old playbook, it needed a really serious update. Initiated in early 2026, this totally refreshed corporate strategy is an evidence-based roadmap. It's designed to guide the city's competitive edge and economic positioning all the way to 2030.
Now, what's really interesting about this next point is the official vision statement makes a crucial, very explicit acknowledgement. Mississauga aims to, and I quote, unlock the full potential of our diverse talent, entrepreneurs, industries, and infrastructure. So the city is essentially admitting that while they can definitely set the stage, they're relying entirely on ground-level industries to actually power this future-ready economy.
To actually execute this, the city outlined 5 new pillars of prosperity. We've got building a competitive and business-friendly environment, strengthening economic diversification, accelerating sector-led growth, investing in talent, and fostering vibrant communities. But here is the absolute crucial takeaway. All these no-go macro goals, they remain just words in a fancy municipal PDF unless actual private sector businesses decide to take on the risk of expanding, hiring, and investing in their own operations.
Which brings us to Section 2, fueling priority growth sectors.
So, you might be wondering, who exactly is driving this growth? Well, 208,300 people in Mississauga are employed by these priority sectors. That is a staggering 40% of total employment. We are talking about nationally leading industry clusters here: advanced manufacturing, logistics around the Pearson Corridor, life sciences, and information technology.
But, and this is a big but, scaling these specific sectors takes heavy, very expensive physical hardware. To grow the Pearson Corridor, you need long-haul trucks and commercial trailers. For pharma, it's high-precision CNC machinery and cleanroom equipment. And for community food service and distribution, well, you need everything from warehouse forklifts to commercial soft-serve machines. You literally cannot execute a grand 2030 vision without the iron and steel to do the heavy lifting.
Moving on to Section 3, the cost of scaling up.
This brings us to the gritty operational reality of actually scaling up your business. Think about this. In a Mississauga distribution hub, a single broken forklift can bottleneck an entire shift. I mean, in a logistical gateway that is handling enormous volumes of time-sensitive freight, operational continuity isn't just some nice-to-have luxury, it's absolutely critical. You simply cannot afford to fall behind the flight schedule just because of a minor equipment failure. No way!
And that builds a massive case for strategic financing. In sectors like food service, acquiring the right assets practically pays for itself. For example, a commercial soft-serve program can deliver up to an 80% gross profit and actually pay itself off in just 6 to 18 months. That's wild. It's not a sunk capital expense. It's a high-margin revenue engine that fuels massive direct gains for your business.
All right, let's jump to Section 4, financing your business future. So,
The crucial point is how you actually pay for this physical growth. You generally face a classic business dilemma here: lease-to-own versus a bank equipment loan. Lease-to-own is great because it conserves your day-to-day cash flow with predictable monthly payments and a lower upfront cost, while still granting you ownership at the end of the term. Conversely, a bank loan gives you immediate direct ownership from day one, but you're borrowing to buy outright, and that often requires a much stronger financial history and definitely ties up your overall borrowing power.
Now, because conventional bank timelines can drag on for literally weeks, and let's be honest, absolutely nobody wants to wait a month to replace a busted forklift, the market has adapted. Specialized alternative lenders operate at the speed of business. You can apply online in under 2 minutes and get approvals rapidly. We're talking within 8 to 48 hours. That means you can source that critical heavy machinery and get it right onto your warehouse floor almost immediately.
And finally, Section 5, Unlocking Government-Backed Capital.
Now, if conventional or alternative lending isn't the perfect fit for you, there are actually federal safety nets designed to lower the risk of expansion. Take the Canada Small Business Financing Program, or the CSBFP for short. It's this really cool federal initiative where the government actually shares the risk with lenders to help small businesses, specifically those with under $10 million in annual revenue, access loans for equipment and improvements. It's just a fantastic tool that supports both established operations and qualifying startups that maybe wouldn't get conventional lending on their own. And this brilliantly illustrates what the actual capital available looks like. A single borrower can access up to $1.15 million in total funding. To break that down, that's a term loan limit of up to $1 million, half of which can go straight to heavy equipment and leasehold improvements, plus a totally separate line of credit up to $150,000. It really takes dense government policy and turns it into highly actionable funding.
Another highly effective route is the BDC equipment loan. And what's genuinely surprising here is that it can actually cover up to 125% of the equipment's purchase price. You might be asking, why does that extra 25% even matter? Well, because it absorbs not just the sticker price of the machine itself, but the true, full cost of scaling a facility. We're talking the shipping, the complex installation, and even the employee training required to actually get it running profitably.
Which ultimately brings us right back to you. The city has aggressively laid out its blueprint to 2030, leaning really heavily on business-friendly pillars and priority sectors. The infrastructure is there, the capital is waiting, and the timeline is officially set. So the only question left is, how will you finance your place in it? Thanks so much for joining me on The Explainer today, and I'll see you next time as we decode another vital topic.